Charles Earl, how will closed-end funds be affected by the widely expected Fed rate hike in December? If you own them, should you sell right now?
Well, Greg, admittedly, a lot of those sectors aren't going to perform really well. The high yield, the government bond, and corporate bond funds are not going to perform well. They have obviously leverage going against them. The leverage will cost more in the fund, eating into income, and the higher rates on government bonds will eat into their competitiveness versus risk-free sectors.
And you like covered call closed-end funds right now. What's special about these? One would think they do fairly well in a sideways market.
Well, covered calls are one of the few sectors we do like. We do have quite a few buys on several funds in that sector. They take advantage of writing covered calls on baskets of equity securities, so they're not as impacted by higher rates. Typically they can throw out 8% coupons, and their returns over certain fund families, like Eaton Vance in particular, have done very well over long market cycles. They do particularly well in flat to down markets, a lot of volatility, and was one of our top sectors right now.
And Muni bonds have performed fairly well this year. Now you like Muni ETFs as opposed to Muni CEFs, closed-end funds. Is this because of the leverage involved?
Well, we like the Muni sector. We do like the ETFs because of doesn't have leverage. We would much prefer like a market vector's HYT, which is really a high-yield Muni ETF. We'd prefer to substitute credit risk right now for leverage. Muni CEFs have one of the highest leverage sectors out there, and that leverage is really all short-term. So when the Fed does increase rates, they're going to get really impacted quite severely. So we'd rather hold off and go on the ETF side now. We might switch that later on. Let's say the market reacts sharply and CEFs sell off, we might switch back into that sector at that time.
I'm going to throw another acronym out there for you. MLPs. You like energy MLPs. We saw oil come below $40 a barrel earlier this week. You think we're going to start seeing some dividend cuts, payout cuts within the MLPs?
Well, it's certainly a possibility, but it's not our core scenario right now. We think the MLPs have been suffered a lot this year. Most recently in the summer, when oil went from 60s into the 40s, they really suffered a lot, and that really impacted the closed-end funds quite severely. And what happened at that time is that a lot of the closed-end funds ran up against their leverage limit. Because of the funds are structured as 40 Act funds, they have a leverage limit at 33%, and the assets fell in value. Some of the funds were out of coverage. They had to sell assets to reduce their debt. That really threw a lot of MLP equities onto the market at a time when nobody really wanted to buy them. So that is, and they've not recovered from that. Even though oil prices have firmed up a bit since then, they're still very soft, and we still like the sector. The yields really can't be beat. We don't think there'll be significant cuts in the sector. We do think that there are opportunities there to pick up 9–10% yields. They may not grow as much as you might expect them in the past, but still 9–10% is not something to overlook.
All right. Is there any other closed-end fund you especially like right now?
Well, we do like, away from MLPs and all that sector, we do like the John Hancock regional bank closed-end fund, BTO, we like. Regional banks, unlike money center banks, have they have much better net interest margins, they have better loan growth. They also have a lot of M&A. It's something that you're never going to see in the money centers again for quite some time. That fund is actually trading at a slight premium to its NAV, something you don't see. Most closed-end funds are trading at 10%, 12% discounts to NAV. BTO is trading at 2% premium when I left the office this morning. It's also throwing out a 5% yield. We like that a lot. John Hancock has a long history of managing bank and finance assets, and we think the regional bank focus of this closed-end fund could do quite well as rates rise.
All right. Well, thanks a lot, Charles.
Greg, thank you.
Thank you for watching The Street.